Welcome, everyone, to this episode of the Expansive CEO podcast. I am your host, Hannah Chapman, and it is Thursday, November 6th at 2:44 p.m. Mountain Time, so the markets have already closed. And this is the next installment of Investment Friday. I am here by myself today. Brad is not feeling good, so everyone listening, I want you to all send good vibes to Brad so that he feels better super fast and can join us again next week so we can have his wonderful takes on what's going on in the market. I wanted to mention, here's your little geography fact for the day. For anyone who wasn't aware, in Arizona, we do not observe daylight savings time. So we are now on mountain time instead of aligned with Pacific time. So when everyone else is in the spring forward part of the year, Arizona is right in line with Pacific time. But when everyone else falls back, Arizona does not move. So when everyone falls back, we now align with mountain time. So just in case any of my clients are listening, if you're wondering what is going on with the time change, your times are staying the same for the most part, and it's me. I have to shift my day by an hour as much as I can for anyone else. So such an interesting little island we have here. I know there are a couple of other places in the country, like smaller areas that don't do daylight savings, but I think the state of Arizona is kind of the biggest one. Also, fun fact, the Navajo Nation in northern Arizona does observe daylight savings. So they have, there's a small pocket up there in northern Arizona where they do practice daylight savings time or observe daylight savings time, rather. But then the Hopi Nation within that, so like a little donut inside, they also don't observe daylight savings time. So we've got this funny little quilt kind of going on here. So there's your geography daylight savings factoid for this week. So getting into what we've experienced this week in the market, it's been very rough. It's been like a rough week. We haven't seen a correction. We're not, and let me take that back. We're not in correction territory. We have not dropped that far at all yet. But this week, so far, through Thursday, we've seen a just over 2% drop on the S&P 500. And, over the course of this year, we've seen mostly growth. We've had a couple of little wiggles a couple of times, but for the most part, the S&P 500 by itself, I'm just checking the actual growth rate now. So we had that a pretty good sized dip in March, but from that low at the end of March, beginning of April, the S&P 500 has pretty much charged up by 20% since April 7th. And so we've gone up 20% with almost no correction whatsoever in that time. And so this week, again, we've so far seen a 2% drop. But again, given how much we've run up over the last 6 months, 7 months, it's no surprise that we are seeing people, one, take profits is a big aspect of when we're seeing market pullbacks. One of it is profit taking. And two, people also deciding, seeing what could be coming down the pipeline that, they just want to take some risk off the table. And so I wanted to talk about some of those factors this week and what we can do. What are some of the things that we can do and some of the things that help us feel more steady in potentially uncertain times? So, what are our uncertainties that are coming up right now? We have a lot of them, right? We have the government continuing to be shut down. We are now on I think day 37 since, October had 31 days. So we're on day 37 of government shutdown, of full government shutdown. It's starting to not only affect federal workers, right, that have been furloughed, many of whom have still been going into work, not getting paid, affecting air traffic controllers, which is a crazy one, who are not getting paid. And again, who are mostly still showing up to work, but they are now, 37 days without a paycheck. Um, and with that, which I talked about, last week, I think last week, the SNAP benefits for families who need food assistance, it's 42 million Americans, still has not been released. There has been some states have jumped in to try to provide partial funding, but most states do not have enough resources to, move around and reallocate to cover the full SNAP benefits that the federal government typically provides from American taxpayer dollars, right? It's not coming from thin air. It's coming from American taxpayer dollars that we already paid into the system in order to provide those SNAP benefits to families. So we've got these big uncertainties for some families, for the families that are relying either on the federal government for their own paycheck because they are a government employee or a SNAP benefit recipient. So we've got those things going on. We've also got a lot of layoffs. We had some news just dropped today, I think, that in October so far, let me grab my numbers. Our job loss reports are showing 153,000, right around, jobs were cut in October, which was the most cuts we've seen in October in almost 20 years. And estimates for the whole year are really close to 1.1 million jobs cut so far this year in the US. And one of the other measures that we look at with that is what's the rate of long-term unemployment, which is 27 weeks or more. So someone who's been unemployed for 6 months, basically. 26 weeks would be 6 months. So they're going into that second, like they've been unemployed for 6 months already, and 27 weeks is now considered long-term unemployment. Those numbers are starting to creep up as well. So we've got the job loss numbers ticking up. The unemployment rates that we were seeing before the Bureau of Labor Statistics got, you know, shut down for now, so we're not getting data from them. The statistics that we were seeing were still that the main unemployment figure, the main rate that, kind of that the Fed looks at when they're thinking about interest rates, was still holding around 4%, 4.1 up to like 4.3% unemployment, which technically is still a pretty good number overall for the economy. That's still considered within the acceptable range. But with these new job loss numbers coming out and some of the big firms, I think Meta, Amazon, Google, lots of job cuts happening this month. Those will add to that figure. And when the government does reopen and we do start to see the statistics again, I don't know. We'll see what it looks like at that point. But 1.1 million jobs cut so far this year is a lot. It's more, quite a bit more than it was by this time last year. I think this time last year the figure was around 654,000. So it's like a good 45% higher in 2025 than it was in 2024. So we've got that weighing on the economy as well. And then we've also been seeing shelter inflation. We talk a lot about shelter inflation on the podcast because it's in the inflation figures. It's one of the biggest components by percentage that we have in the CPI, the Consumer Price Index, and the PCE. Right. So when we get these inflation figures. Shelter inflation is a really big component of those numbers. And so right now we're looking at shelter inflation numbers that are down nearly 10% from the previous peak. So the graph, when we have it, Maybe we'll talk about this next week when Brad is here and he can show us the graphs. It's down a lot. It's, a good 9.5, almost 10% negative from where it was. It's still higher cumulatively. It's still higher than it was, 4 and 5 years ago. We've still experienced a lot of inflation over that time, but rents are coming down. When shelter inflation is coming down, that means rent prices are literally coming down on average around the country. So even if that's not true specifically where you live, let's say you live in a city that's growing really rapidly, you live in Austin, you live in San Francisco, you live in the Phoenix area, you live in Denver, right? Rents might not be going down where you are, but across the country, average rents across the country have been coming down by about 10%. And it's been interesting as well. I have had some clients who do own real estate, who do own rental properties, who do own Airbnb type properties, be saying anecdotally that they can't get their homes rented for market value, or they can't keep a tenant, or they aren't getting the short-term rentals at all right now, right? And so that's another little shaky piece as well. So the other piece, when we talk about layoffs, a lot of those are in the AI space or in giant tech companies. And what is happening there, this 2% loss that we've had so far on the S&P 500 this week, a lot of that is from our, quote unquote tech giants. NVIDIA, Palantir was in there as well. Peter Thiel's company. Lots of interesting things happening there, to put it lightly. Anyway, but a lot of our big tech companies are leading that, slide right now. And part of that, it's kind of brought up, and we've talked about this before on the podcast. It's brought up, is the AI trade, is the AI industry a bubble? Is it a bubble like the internet? We had the .com bubble in 2000, 2001. There is a very strong argument against the fact that this current AI boom is a bubble. And I would argue that it's not a bubble in how it's being supported by actual earnings and actual chip making, actual infrastructure building, actual data center building, actual people utilizing AI in significant ways. That is actually like firms like NVIDIA. NVIDIA has current income. They have a lot of income. They are also, part AMD is another one. There are a lot of AI centered firms and chip making firms in particular that are making a lot of money. And what's different about that versus the .com bubble back in 2000, 2001 was that there were internet companies it was like anything with a .com that existed, any new business, like money was just being thrown at internet companies left and right. Even if those companies had absolutely no track record, absolutely no earnings to speak of, it was such a huge push, and people were so excited, we'll put it, like to the point of buying frenzy, that anything that was related to the internet space was going to, definitely take off, was going to be a great bet. And lots and lots and lots of companies that had no earnings or no real plan for how they were going to stay in this space went completely bust. Right. And so that is a bubble. That is a bubble when you see firms that are experiencing huge growth, but without any substance. When you think, I mean, that just makes sense too from a metaphorical standpoint too. Like, what is a bubble? If you blow a bubble, it gets bigger and bigger and bigger, but there's no substance inside. It's just air inside, right? So that's literally what was happening with these internet companies back in the dot-com bubble. And that is not the same. I mean, I'm sure there's an argument for some companies in the AI world that there are certain specific companies that might fit that description. But most of our big players, AI is either an augmentation to what they've already been doing or an addition. Think about Microsoft, for example. They are not an AI company first, but they have a huge AI component at this point with Copilot, their Microsoft Copilot. And that is, something that they're investing heavily in and something that they're selling, right? Like big tech firms or big enterprise firms are buying, spending lots of money, literally spending millions of dollars to integrate Copilot into their systems. And Microsoft is getting paid for that. But Microsoft also has, multi-billion dollar firm that is based on software and hardware and other pieces of the business, right? It's a solid company, very, very highly likely not going anywhere, that's adding AI as another income stream. NVIDIA is, excuse me, is part of that as well. Like they make semiconductor chips, right? Like they make a physical product. They also are involved now in the application of AI. So they're looking to transition from building the hardware, building the infrastructure to also supplying the application of the software. And that means like when you think in terms of bubble, it's not expanding with nothing on the inside, right? There is a core business there that is still profitable, like insanely profitable, that's still solid. So again, that doesn't mean there aren't some firms that could fit that bubble definition, but that's true in almost any space, in any innovative space, right? There are always going to be companies that come in and say they can do all kinds of things and it turns out they can't and business goes belly up. But some of our big movers and shakers in this space do have a solid business underneath them. So what does that mean in terms of like, well, why are we experiencing this downturn this week? Well, we're seeing it because those firms, while they do have solid business structures underneath, they also are currently priced for perfection. We've talked about this before also, so this is more of a reminder, but when anything is priced for perfection, when any company is like, means their price to earnings ratio or their PE ratio is super high. And right now we'll use NVIDIA as an example and a reminder and compliance check. This is not a recommendation to buy any stocks at all whatsoever. This is purely for educational and informational purposes. So when we talk about the price to earnings ratio, NVIDIA is currently sitting right around 56, 57 PE. That means the price to the earnings, the price of the stock is 57 times higher than the earnings. So for every dollar of earnings, they're expected to turn that into $57. It's kind of a one way for you to understand that, right? So if the stock costs $100 per share, it doesn't right now, I'm just giving round numbers. If the stock costs $100 per share, it's expected that it will provide you $5,700 in benefit. Okay. So what does that mean when they give us like, oh, we are forecasting that next quarter might be lower than we originally thought. Even if they come out with strong earnings in Q3, if they tell us, we're not super sure about Q4 or Q1 based on some of the things we see in the economy. Well, even if they just had amazing results, which I think they did when their earnings came out, if it's not looking like they're going to repeat and even better themselves in Q4 and then in Q1, investors start to take money off the table. They're priced for perfection. And so any single mishap, any even like whiff that the markets get, that there could be a challenge ahead, that's going to cause the stock price to fall when it's, way up on a pedestal. We'll put it that way. So again, it's not surprising for the market to be experiencing the pullback it's experiencing, given all of those different factors that I just talked about. What then does that mean going forward? One thing it probably means going forward, um, and most futures analysts are aligned with this. Most traders are expecting to see an interest rate cut in December. We've got the shelter inflation number coming down. We've got again the job losses coming in. Those things, inflation coming down, shelter inflation coming down is going to bring the overall inflation number down. So especially with job losses going up and inflation coming down, that does hit those trigger points for the Fed to say, hey, we need to cut interest rates again. So it would be surprising if the data stays similar to how it's looking right now. If we stay kind of on the course that we're on at this moment, um, it would be surprising to not see a rate cut when we get to December, but we will have to wait and see for that. And it would be also interesting if we stay on the pace that we're at with job losses, if consumer, retail spending comes in low, there could be even a case for a 50 basis point or a 0.5% rate cut rather than just a 25 basis point or a 0.25% rate cut in December as well. So we will see what happens with that. I wanted to shift then to, what do we do with this information? How do we stay grounded? How do we stay I don't want to say positive as in like just ignore all the things that are happening in the world. If you've known me for any length of time, if you've been listening to the podcast for any length of time, you know that I cannot turn away from what's happening overall, what's happening in the real economy for the majority of Americans and the majority of citizens around the world, right? That matters truly to my heart, and I think from a from an overall perspective on our economy, when we all thrive, when everyone thrives, um, it makes it better all the way across the board, right? When it's just a few at the top that are thriving and everyone else below is really, really struggling, that creates a situation that cannot last. But how do we create abundance and prosperity that can last, that doesn't have to go through, a bust and boom of a middle class cycle? It's to make sure that everyone is thriving as much as possible, right? And how do we get there? I think there's a whole lot of ways. We don't have to go into that. It's not what this podcast is for today. Um, but one day, maybe one day, we'll talk more about that. The overall thing that I wanted to ground into today, though, is that for each of us individually, so collectively, things have to shift with how we experience wealth across the spectrum, across the globe. It's not just in America. America is a pretty good microcosm of it. But individually, individually as humans, how do we help ourselves stay in a more positive mindset and a more optimistic mindset, and avoid going down the anxiety spiral, avoid going down, the scarcity spiral, and getting really worried when we see the stock market fumbling, we see job loss numbers coming out, we know that, things might be uncertain. I do, I was thinking about like, what are the things that I do and what are the things that my clients do? And so here are a couple of pieces that I think are super, super important, in no particular order, I guess. So if you have, first of all, if you have a long-term plan in place, so you know what your long-term plan is already, and you have a properly diversified portfolio that's right for you and for your family and for your goals, and you have your cash reserves built, right? So let's say you have all those things in place. You've got your long-term plan, you've got your properly diversified portfolio, and you have your cash reserve. This should be most of my clients. We might be working on the cash reserve, but this should be most of my clients, like truly. My recommendation is that you stay the course and consider making a commitment to yourself to not look at your portfolio for the next month or so. See if you're someone who looks regularly, try to like see if you can just go about your day and not look, if it's going to make you anxious again, if it's going to make you feel yeah, like your chest tight and your stomach drop, if that's how you're going to feel, if you see that your portfolio has dropped a little bit, I would really, really suggest like just don't open it. Just don't look for right now. You're going to keep doing what you're doing. You're going to keep, working your business. You're going to keep doing your job, making your choices that are going to keep you moving forward in life. And you're going to let the professional money managers do the job that you're actually paying them to do anyway. Okay. My sincerest hope is that all of my clients feel that way, that they know that, we have their back, that we're the ones, we are paying attention, we are watching, we are checking the markets every single day, literally every hour, literally have tabs on what your portfolio is doing. And we are making those adjustments as needed. So you don't have to worry about it. You don't have to be in any mode of anxiety because we know what your long-term goals are. We know what the portfolio should look like, where the tolerances are, and we can we can help ride the waves and surf through the uncertainty on your behalf because that's what we're here to do. Okay, super super important. So, and for anyone else, you have a long term plan, you have a properly diversified portfolio, and you have your cash reserve. Again, stay the course. This is part of the market cycle. If you feel strongly that there's like a piece of that, everything always has its own flavor. Every downturn, every correction, whatever we're going through in the market will have its own little flavor of how it's impacting others. If that pulls heavily on your heart in any way, for me, it was the SNAP benefits. That really, really weighs heavy on me, on my heart. And so what did we do? We donated to a food pantry. We, took our dollars and we have extra dollars that we can allocate to families in need where they're going to take that money that we donated, and they're going to be able to do even more with it than, if I go to the grocery store and buy that same amount of money, if I were to buy groceries myself, it's actually going to go not as far as if I donate it to an organization that has the resources to buy an even bigger wholesale, even bigger bulk, buy exactly what people need, the proteins that they need, the things that they actually want, the things that their kids need, right? Like all of that. I know I can take what I have that is extra, that is part of, my abundance, and I can share it in the way that my heart is like, this is where we need to help right now. And I know that I can do that. I know that I can do that because we are on track for our other long-term goals. We are on track with our diversified portfolio. We have our cash reserve, right? And that didn't eat into our cash reserve. Like I know that my family is safe and that we're okay. And I can then take from my overflow and then put it where I am most called to do so. Okay. So that is one of the action items that I can share too, is that again, you have all your stuff in place. You can then look at the situation at hand, the situation in your community, the situation in your family, whatever it is, and you can choose if you want to help, if you want to pour into to help the people around you in whatever way feels right for you. Okay, so that's a big piece, and that is important because when I say like make choices that will keep you moving forward in life, that's a piece of it. That's a piece of it. So if you're saying we have to do something, we have to do something, we have to do more, okay, this is your chance to do that. You get to do that now. Second, that cash reserve piece. The cash reserve piece is so key. And I want to talk about how important it is and how I talk to clients about building and keeping their cash reserve, both from a personal cash reserve standpoint and a business cash reserve standpoint. So for personal cash reserve, like it's very super common to hear the recommendation of 3 to 6 months of regular expenses. That's totally normal, right? So when we are talking about regular expenses, what does that mean? That means your mortgage or your rent, your car payment, your normal food spending. Okay. Uh, I mean, you can look if it's normally a lot of eating out or a lot, you can judge for yourself what you think your actual core food spending is each month, but just be like, no, it's fine. Like whatever you spend, like it's not a judgment or no reason to say, is this too much or whatever, but just paying attention to how much do you spend at the grocery store and then how much do you spend eating out. So you have an actual clear number, right? So we want, again, all your liabilities, your insurances, your food spending, um, anything that you spend for your kids, if they have, normal activities that they do or after school care or, babysitter, anything like that, whatever your core expenses are, if you have pets and their pet food, and you want to take that number, take that whole entire number. Let's say your core expenses are $8,000 a month. You want to take that, and 3 months is then going to be $24,000, is going to be a full 3 month cash reserve. But we want 3 to 6 months. Okay. So a full 6 months of cash reserve. If let's say, again, your core expenses are $8,000 a month, that's then going to be 48,000. So you want somewhere between 24 and $48,000 saved as your cash reserve. And this does not include savings. Like if you normally put, $1,000 or $2,000 into just your regular savings account, and you have your retirement savings, you have any other savings. We're not including savings in the core expense number. We don't need to do that. Okay. Because if something happens, if someone loses a job, whatever, we're not going to worry about saving for the future at that moment. We're going to be worried. I'm not even going to use that word. We're going to focus on just making sure core expenses are met. There are also some schools of thought that like not everything is a core expense. And I also challenge that a little bit because when when something happens in the family, if someone loses, again, someone loses a job or someone becomes injured and unable to work or sick and unable to work, you are going to change how you are spending your money every day. Like you're naturally going to start, for most people, they're naturally going to start paying more attention to the food budget. They're going to start paying more attention to the extra stuff. And that's natural. So, in one way, we actually created a bigger buffer. So now you're safer for even longer if shit hits the fan, right? You're actually going to be okay for longer. But it also allows for like, hey, if there's an illness, there might actually be higher expenses for a little while. Um, if you're job searching, there might be other random expenses like, okay, I have to go, get new clothes for an interview. I have to do XYZ, right? Like you don't know what those extra expenses are going to be that you didn't have before. So we really do need to have that full buffer. And I don't want people to take that and their cash reserve and be like, oh, I just need to have enough to pay my mortgage and my car payment and like the bare minimum of food because that leads into scarcity much more quickly than we need to experience. And what I know from being in this business for, since 2007, 2006 in banking, 2007 in financial planning, and going through the 2008 crisis and then going through several other crises in that time in the financial planning space is that people who have their cash reserve in place, both personal and business, those are typically the families, the individuals, the businesses that have the easiest time weathering the storm, do it with the most grace, are able to extend a helping hand to others as well. And they make it through to the other side. I've seen it happen over and over and over again. And I mean, to the credit of the firm that I came from before I started X Squared, I was with them starting in 2008. I think March or April of 2008 is when I started with them. And they had to dig into their savings in order to keep paying their employees in the worst parts of 2008, 2009. And so, literally, not only did I get to witness clients who were doing the same, who had prepared appropriately, who were able to weather the storm, I personally was a beneficiary of the owners of the firm having done their work, having done the same thing, having made sure they had their cash reserve in place so that they could dig into their very own savings to pay the employees. We had a big team compared to other firms at the time in the area, and not one person was let go because of the downturn. And that is an absolute, again, testament to the importance that they placed on team and also the importance of the work that they had done to prepare. And the biggest piece, so I mean, like, even to my point earlier of like when you have your cash reserve, when you have your long-term plan in place, when you have all of that, and you feel safe and secure and stable, it gives you the ability to know like I can help in this way. I can help others through the uncertainty, through if there's a crisis, if there's a need. The fact that the partners of my old firm were able to keep all of these other families afloat throughout 2008, 2009 is huge. It's huge. And I know, I mean, I work with other small business owners so many of my clients are small business owners, and I know how much, like how big of a responsibility it feels on your heart to take care of your employees, to not, to not lay people off, right? Like that's the last thing that we want to do. Small to medium sized businesses, like it's really, really across the board. The business owners that I talk to, it's so important. They will pay their people before they pay themselves. And when we have a cash reserve in place, we can rest easier knowing that yes, you're going to be able to pay your team. And what I hope for you as the financial planner that works with lots of business owners, my hope is that we've planned well enough that you can still pay you too. That's the whole point. That I also want you to be able to continue to pay yourself, that you have your personal reserves built, and then the business side is also built. So let's talk about business cash reserve for a second. I typically like to see 6 to 12 months of business expenses put away for business cash reserve. And for some smaller business owners, that might seem crazy, right? If you're regular, let's say you're doing $100,000 a month and you have $60,000 a month of expenses, of regular expenses. That's your employees, that's your tech stack, that's your cost of goods sold, that's everything all together, right? Like maybe your rent, if you rent a space, or own your own building, right? Like there's that payment. Let's say $60,000 a month all in. So you might be thinking like, are you saying I should have 360 to $720,000 set aside in cash reserve? Yeah, I am saying that actually. I am saying that. And I am saying that from my experience over the last 20 years, it is the small businesses that have had something in that line, at least 6 months, up to 12 months, maybe even more of cash reserve. They are the ones that can make it through uncertainty. What that gives you is that gives you time. If you have a 12-month reserve, if you have $760,000 put away, we'll say $720,000 put away as a 12-month cash reserve, that gives you time to make decisions thoughtfully. That if the economy is going through a big adjustment, if things are shifting, if industries are shifting, you can rely on your cash reserve while you pivot, while you figure out what your pivot is going to be in order to stay afloat, whatever that looks like. Okay, so it's super critical, right? And your ability as a business owner to keep paying your employees and then to keep paying yourself as well, that's doing so much. It truly is doing so much for the economy, even just to be able to keep paying your employees, that they can continue to put food on the table, right? So your generosity, your ability to future plan, to pre-plan, is allowing you to stay generous, allowing you to stay in your heart of giving, in your heart of serving your community, like literally by paying your employees and allowing them to continue their life, right? And continue paying for their kids' school lunches and buying food and supporting their community, right? Because then your employees are probably going to do the same thing and give back to their community in the ways that they can. So it's so important to have that cash reserve in place. What do we do with it then? If you have, let's say on your personal side, you've got $8,000 a month of expenses, you want that 6 month cash reserve. So we've got $48,000 in cash, or on the business side, you've got 60,000 a month in expenses. So you have $720,000 in your cash reserve. For a lot of people, first, I would love for you to do that calculation and then multiply it for your personal, multiply it by 3 to 6, see what that range is. And then for your business, and multiply that by 6 to 12 and see what that range is and just sit with it. See what it feels like to say, oh, okay, I should have somewhere between 24 and $48,000 of cash reserve. What does that feel like in your body? What comes up? What messages come up? What thoughts come up? What emotions come up? This is a really, really interesting place where money stories come up a lot. And then on the business side, when we're talking even bigger numbers, right? $360,000 to $720,000, what comes up? What thoughts? What emotions? Let's really just be really curious about how you feel about that. And then from that space, it's like one of the things that people say like almost right away is like, oh, well, I can't just leave that in cash. Like that feels wrong for it to just be sitting there and not doing anything. Like I feel like I have to squirrel it into something else. That's where positioning the cash reserve is so important. I never recommend someone just keeps, let's say the 48,000 number is right for you. I'm not going to recommend that you have that sitting in a checking account earning nothing. I don't even recommend that you put it in just a regular savings account usually because they're earning anywhere from 0.01 to 0.05%, almost nothing for a regular savings account. Instead, what we do is we have a tiered system, and this is all across, whether it's personal or business. You have a tiered system where you do keep some close at hand. We always keep a little bit close at hand. I typically like to see at least 1 month of the cash reserve in the checking account so that you do have a buffer. You always are maintaining a checking account buffer, and that's your first level of reserve. Then the second level of reserve is your savings account, and we might keep like 2 months in there. So for this hypothetical example, this is not specific advice for anyone. Her hypothetical example of someone with $8,000 a month of expenses, they're going to keep a buffer of $8,000 in their checking account as their first month. Then they're going to keep $16,000 in their savings account as their second tier. And maybe that's earning 0.5%. Maybe you're lucky. Maybe you do have a bank where they have a high yield savings and it's 3% right now. Great. Yes, do that. Okay, so you've got 8,000 in the checking, 16,000 in the savings. You've got your first 3 months, $24,000 of reserve right there. If you have the other half, if you've got the third to 6 month, or 4 to 6, I guess, 4 months, 4 or 5 and 6, that's where we put it into something else, like a short term, either a money market fund or a short term bond fund, something else that actually is earning a higher percentage, that is still completely safe, that is not going to go down in value, but is also accessible. I am not that I'm never a fan of CDs where the amount is locked up for, it could be 1 month, it could be 3 months, it could be 6 months, it could be 5 years. But typically, if you need that for a reserve, having it in a CD is not great because if you have to tap it in the time frame that, if it's a 6 month CD and you have to tap it at month 5, a lot of CDs will then get rid of you lose all accrued interest if you have to take any part of it out. So I just don't find that to be super helpful. So instead of using an instrument like that, we use something that's flexible, something that you can sell at any time, but that's going to get you a higher interest rate on those cash dollars. And so the same thing is going to apply for a business as well, that you can utilize these short-term money market type instruments or short-term bond instruments or different things like that, whatever is right for your situation, to continue to earn interest on that money, even though it's not, in the market potentially earning, your average 8 to 12% per year. We don't want your cash reserve dollars to be anywhere near the stock market because we want those to be available when you need them. We do not want them to be fluctuating with the market. Something else came into my awareness and then just like flew right out. Happens to the best of us, right? So overall, having that cash reserve again in place is so important. It's so impactful beyond just your own personal situation. It's not something that is just good for your own family. And I think overall, this is like a really important thing. And I'll end it here is that when you take care of yourself, when you take care of your family, that like when you have your cash reserve in place, when you have your long-term plan in place, that is an act of self-love and an act of self-care to have those things taken care of. Even if the situation changes, even if, like things fluctuate, that's normal. That's typical. When you have a relationship with a financial advisor that grows with you, that helps keep you stable amongst the chaos, that is self-care, that is self-love. And when you do that for yourself, when you build that stability for yourself, one, you're showing that stability to your children. If you have them, you're helping. Even if you don't have children, maybe it's your siblings, maybe it's your own parents, maybe it's your employees, right? You are creating that stability within yourself, and that stability ripples out to the people that depend on you, whoever they are, wherever they are. And that stability then allows you to be the one or one of the, Mr. Rogers says, whenever there's crisis, find the helpers. Look for the helpers. There are always helpers. And that allows you to step into that role of being the helper in times of crisis because you are self-sourced, you are resourced, you are stable, and you know it, and you are then able to pass that generosity, pass that. Your inner stability helps create stability for those around you as well. Your monetary, your fiscal stability helps create that for others as well. I'm not saying that means you need to give money to everyone, right? Like that's not the takeaway here, or that it's your responsibility to do so. But even if you feel resourced and you feel like I'm stable, I have my plan, my cash reserve is in place, and I have time, right? If it's, I can donate my time to this, I can donate my energy to this, that is generosity as well, just as much as monetary generosity. When you create your own stability and you commit to creating that, you can give, those are my three buckets that I teach: time, money, energy. You can have true prosperity in all of those buckets. And then you can choose to give where you have overflow. If you have time, if you have energy and you want to give in those ways. Or maybe you're like going full steam ahead and you don't have the time, but you do have the money and you want to give the money. That is so impactful and so helpful when you have created the stability for yourself that you can then extend that to others in any meaningful way. So, cash reserve. This was a whole thing on how important it is to have your cash reserve in place, to have your long-term plan in place, um, to have the right portfolio for you, the right risk tolerance, and then to have a team that's taking care of it on the daily. And if you don't have those things right now, I would love to talk to you. We would love to talk to you at Juncture. Um, our team and our process is amazing. I appreciate them so much. I appreciate Brad so much, and our team, and Wanda and back office, and everyone who works with our clients. And we have space. We have room. There's always enough room. Always enough room for more wonderful heart-centered, loving, impact-driven people to come and experience this stability, experience this way to help create these waves of generosity and stability and change the way that we experience wealth in this country and for ourselves and for our families and for our children and our grandchildren and all the future generations, everyone. So thank you for listening. If you have any questions, if you have any thoughts, any topics that you want to hear about, always send them. I love to hear people's questions. You can DM me on anywhere where we're connected. You can send me an email at the email listed below. You can contact Brad. We would love to hear from you. So everyone, be careful out there. Get your cash reserve ready, and we'll talk to you next week. That's it for this episode. Thanks for listening, and be sure to like and subscribe. And again, if anything resonated with you from this episode, I would love to hear from you. Email me at Hannah, HANNAH, at expansiveceo.com and tell me about it. And if you're ready for your greatest expansion, you can find ways to work with me at expansiveceo.com and at x2wealthplanning.com. That's X, the numeral 2, wealthplanning.com. So until next time, remember that there is enough, you are enough, and your birthright in this lifetime is to be expansive.